Thank you, Dave. Good to see everybody. And Steve, it's good to have you up here.
Well, thank you for having me.
He was just telling me how impressed he was with the room and with the crowd. And he can't see everybody through the camera, but that's a big crowd too. You should take a picture for your kids before we get off stage.
Okay.
I saw Steve back in September in Boston, and he said, I can't wait to come down to Florida. And I said, great. Particular reason? And he said, because it's named after my fund. And I said, what do you mean? And he said, well, I run US Focused Stock Fund, and this is Focused Palm Beach. So we can go with that. I wanted to start with the fact that this session that we're doing for the next 30 minutes is about concentrated investing in US equities. Mm-hmm. And I know there's a lot of concentration behind what you do, but there's also a concentration in equity selection. You've got 40 stocks in this big market.
36.
Let's start there. Tell us all about it. Let's unpack it.
All right. So the way I look at it is my one advantage, so a couple things. Stocks follow earnings. My one advantage is I work at Fidelity, and we have access to companies and able to probe their growth potential, their earning potential, and I use that advantage to go through the S&P 500 and quickly get rid of things that we cannot own in a concentrated manner, companies that are over-levered, companies that don't earn money, companies that don't grow the revenues, and it leaves a group of stocks that I then focus my time on to thing. And so as you run a concentrated fund, as I told audiences before, my goal is to crush the S&P 500 and not lose my job. So you can crush the S&P 500 one year and then get fired the next year if you own too different types of stocks. But so I tend to own stocks that are kind of down the fairway. Companies that are growing their revenues, companies that are growing their earnings faster than the market, and they're trading at reasonable multiples. And what I do is, as they appreciate in things, I recycle the money and put it in the next name, and it keeps the fund associated usually with some very good secular growth themes, not because I'm saying I want to buy these growth themes, because you never want to buy a growth theme. You want to follow the earnings. And so if you follow the earnings, the fund usually has some good growth themes in it. So that's what I do every day.
So where did you come up with 36?
Well,
and what's the range?
Well, the range, I can go to 60. So 36, as I've told people, is, and it's, I wish I could tell you it's some type of logarithm and I've got this thing, but basically I have a screen on my desk. I run 5 different funds. And so for this fund and the US version of it, basically I decided I'm going to do one column on my spreadsheet. So 36 is one column. Okay. So I know if I get outside of the column, I need to get rid of a name. So it sounds very, but that's how I do it. 36 names.
And if somebody buys you a bigger monitor, does the fund get larger?
Bigger monitor, or if I change the font. I'll be back here next year. It could be at 44 names. Okay. If I go from 10 font to 12 or 9 font, or whatever, it could go up. But that's what I do. And it's a good point, because I was talking earlier before I came up here. I run zero cash. So you can't run zero cash. I have 0.2 cash because you have flows coming in and out. So a name has to win its way on the team. So as I look at my 36 stocks, and today, or not today, I'll be on a plane, but tomorrow when I'm meeting with a company, as I look at it and I look at the upside downside, I'm like, is this player better than something in the fund exists that I already have? And so when something happens, I have 2 trades. One comes out and one comes in, because it makes me, I don't want to have name creep. And so I want to keep it in the best names. And so there's a lot of times when we go into things, whether it's electricity is a big thing with AI and stuff like that. There's about 7 or 8 great ways to play electricity. I've got to pick one. There's 7 or probably 5 or 6 good ways to play connectivity. I got to pick one. Mm-hmm. So it makes me not only get the earnings right, the trajectory right, but then I got to pick the hopefully the name right within the group.
Oh, let's talk more about that scrutiny of picking names. You said about meeting with companies, which you'll do tomorrow, I'm sure. You're on the 11th floor. The 14th floor is where all the companies come in. You can go up and see anybody you want. That's true of anybody, any investment professional at the firm. And when you go in to see a CEO or whoever is sent to talk to Fidelity, what kind of questions are you asking these days, especially in this environment?
Well, I wish I could have something
in general.
I wish I had something. Well, you basically, you get, depending on what industry they're in, you're asking what the core of their business is like this, and then you stop and you say, okay, AI, is it going to be a benefit or a threat?
Yeah.
And what are you doing?
Right.
So not only is AI the number one investment theme for most people who are running growth money in the US, it's also the next leg of AI is going to be which companies adopt it the fastest and the best. So whether you're running a hospital, whether you're running an insurance company, we just talked to an insurance company, the stuff that AI is going to do for the collection of data before they make the underwriting decision. This company went through how they're underwriting all the hotels owned by Marriott around the world. And it usually took them 3 months to get the data into a folder where they could sit down and decide this is going to be our price. And basically he goes, we're doing that now in 1 day. And so things like that, it's going to save a lot of people money. So, but basically it's not a very hard business. How fast your revenue is growing? Are your margins going, are flat, down, or up? How's your balance sheet, so interest expense? Any change in the tax rate? Are you buying back shares, issuing shares? And how much CapEx are you spending? And what are you using your free cash flow for? So the process of going through companies is the same, but now we have a new tool, no different than the cotton gin or the Gutenberg press or the internet. We have a new tool that people can enter into their system, and for some people it's going to be great, and for some people it's going to be really, really bad.
So you see AI as something to amplify what teams do versus something that's going to get in the way, if they adopt it correctly.
Correct.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
When you meet with earnings season's begun.
Yes.
And I just want to preface it actually
Thanks.
by saying, I think I saw this morning on CNBC, CEO confidence seems to be faltering. Do you sense that, or have you sensed that in meetings that you're doing?
Just depends what industry you're in. So I don't really look at pools of things like that, because if you're trying to sell boats, RVs, cars, anything that is over 50, and even houses, anything that's over 55 to 70% financed, and you ask them how business is really bad. But then if you go over here and you talk to people that are doing HVAC for data centers, electricity for data centers, anything for data centers, and so like that, it's never been better. And some of the exciting new like GLP-1 drugs and stuff like that, they can't build the factories fast enough. So when you take a survey of all of them and say it's going like this, as a focused fund manager, I really could care less. I feel bad for them, but I could care less about what's happening over here, because most of my names I own are, as you'll see Will Danoff later today, are smiley face type companies.
How do you keep? You mentioned AI data centers. Those are bigger than Amazon warehouses. They're 1 to 2 million square feet. They're popping up all over the place, and they have a lot of inputs. And I'm sure you see so many companies that are supplying widgets and all sorts of things for these data centers. How does that affect you, though, from a concentration standpoint? Because you want to keep your 36 to 60 names, but now there's all these interesting companies that have got a new business supplying data centers, as an example.
That's a great question. You have to. as a new name comes in, you're like, what is this doing for our stew? Because I look at the fund a lot of different ways. And one way is it's a nice beef stew.
That's nice.
And you don't want the beef stew to have too much potatoes, and have too much meat, or it's too spicy. It's got to be right there. So you can go all in and have all AI, but then if you got too much Tabasco sauce.
Yeah.
So basically, as you look at this thing, you have to understand a new name. What is it doing for the portfolio? And yes, it may be coming in connectivity, but actually it's not the correlation with doing HVAC and connectivity or transformers versus HVAC. It's really the same. It's the same CapEx dollar.
So the fact that you're adding a name, but at the expense of something that has to come out, you must digest an incredible amount of information that comes through you. How do you deal with that as a as a portfolio manager?
That's a very good question. So yeah, the biggest thing I wish we could go back in time and get rid of is email. I really hate email. I think it was one of the worst inventions we've ever had. So I get 1,000 emails a day. Mm-hmm. So even when you're on the road, you get up early, you open your thing, and you sit there with the delete button going, and then you read 3 or 4 out of 1,000 and stuff like that. So data collection or data processing is what I do. I have that. I have our internal research. I have the street research, and then you have the conference calls. So one of our top 10 holdings, Bank of New York, reported this morning. They had a 7:30 conference call. I didn't listen to it. I was doing a photo shoot outside.
I hope it went well.
You got to have priorities in life. So that's what I do. I have to prioritize my time on where to go. And so as you talked about, I'm going to repeat myself again. I need to go through, there's 504 stocks in the S&P 500. At the end of every quarter, I have a massive spreadsheet, and I sit down and I have a price target of upside and downside for all 504. Some are based on dividend yields, some are times priced to sales, some are priced to earnings, some are priced to book, some are just have to make up because they have no revenues, earnings, or anything. And basically, as I go through that, I have piles of, it's like fishing. You're like, no one has ever caught a fish over here. Do not fish here. Sometimes you catch a fish here, take a little look, but the fishing is good right here. And so I spend my time in this pile. And so each quarter and every day, I'm basically trying to figure out what stuff is moving from the do not fish into the fish, and what is going from fish into everyone's already caught up with the fish. So as I look at this thing, that it's a game, and I'm basically moving the parts around to make sure we have the best 36 players.
I don't know what I want to have for lunch, beef stew or fish. We'll figure that out later. So let me ask you about, so Neil Constable is going to be up speaking later. He heads up QRI, Quantitative Research and Investing. Does that factor into helping you filter names, the whole quantitative? This is kind of new stuff for the industry, but for Fidelity, it's a big expenditure.
Yeah.
How does that help?
Oh, it helps a lot. So, and I wish, I'm greedy, so I wish it was going faster. I don't know if Neil's out there. But as I look at my stuff, I have now different ways of looking at this information. I found someone who is going through all of the research notes and giving me a score based on the words that are used in the research note to determine whether it's a happy face or a frown. I have someone else that is going through and doing changes. So if you change in your model, if you change anything, it's red flags that said, ooh, they changed their margin. Because you look at these spreadsheets, they're down in, you talk about 36 names in 10 font. These things are like 6 font, and you're like this going, who can read that number? But so I've got things look at changes, and then I've got another person doing screens. That is because so this morning, Bank of New York was supposed to earn $1.74, and they earned $1.91, earnings up 23%. And so the out-year earning changes. I have something that's automatically showing me what the 26 and 27 earnings changes are, and it gives me the next day. So I get the list of companies whose earn, because stocks follow earnings. So I've got people watching the earnings, the sentiment, and going through my data that I can't process.
Wow. So you said stocks follow earnings. Will Danoff talks about that a lot. I think
Yes.
you sit beside him, office-wise. But
2 doors down.
what have you learned from Will? What's it like working with him, and who has a larger number of holdings than you do as well?
Oh, he has 22 times more holdings than I do, roughly.
Yeah, that's my math too.
No, it's Will and I've worked together for 34 years, and it's his energy, and he goes to the next meeting. Mm-hmm. He's doing it, and so I'll be sitting in my office. It's getting late in the day. I'm thinking, which train am I going to catch going home? And he comes by and he goes, "So and so's in." I'm like, "Oh yeah, they are, aren't they?" And he's like, "So next thing you know, I've got my clipboard. We're upstairs at the meeting," yeah. And I'm thinking I could have missed that one, but no. So what I've learned from him is go see everything, because the key. So I told you I'm avoiding this and buying this, but you don't know how good this is without knowing how bad that is. And so if you have to see the whole spectrum of stocks to know that, you know what, that's awful. And it's trading at 8.8 times EBITDA. That's medium bad, and that's at 9.6 times. That's okay, and it's at 10.7. This is awesome, and it's only at 11. So it's like as you go, you need the whole spectrum to do valuation. And so from Will, it's go see another company, and no one sees more companies than him.
Yeah, and he drags you along.
Well, only now and then, because he knows what industries I used to cover: newspapers, printing, check printing, railroads, trucking, shipping, cable equipment, and energy. And so he, as an analyst, and so when he says, he'll come in and go, "Oh, CSX Railroad's in." I'm like, "I'm not going to buy CSX Railroad." I'm like, "Okay, I'm going." And I'm up there. So when he sees something that he knows I have covered in the past, but that was in 1992. Well, I tried to remind him, but Will, that was in 1992, which is a long time ago. But
it brings up a great point that analysts cover a vast amount of sectors before becoming a diversified portfolio manager.
Yes.
What was your favorite sector when you were an analyst, if you think back to that time?
Railroads.
How come?
Because they just changed the rules on pricing, which they just started earning money, and then that set off it was a Staggers Act, and they basically were able to change the way they did pricing, and so then what happened, it set off all the mergers. So Burlington Northern bought Santa Fe, Union Pacific bought Southern Pacific, Norfolk Southern and CSX they split Conrail, which if you ever watch this, each of them, I think the initial bid was 55, the next one bid 60, 65, 70, 75, 80, 90. They got to 100 and they said, okay, let's just split it. So they paid twice as much as they should have paid, and they only got half. So, but it was an exciting time because not only was the business model changing, because you gotta remember they had an operating ratio, which is the inverse of operating income. They had operating ratios of kind of 92 to 93, and now the industry is at 63. And so that 30 points of operating margin happened mostly during that period, and that's why they were doing mergers, and they continue to do mergers because they can go in and cut a lot of costs.
You remembered a lot of detail from the 90s. That was great, but that shows how it formed a lot of your thinking today. Questions just come in. I mean, a lot of people saying the market is very expensive, but our audience are asking about how do you assess current valuations where they are right now, or how are you assessing current valuations, and which risks are most important to monitor?
There's a lot of risks. Tariff risks, location risks, currency risk. There's a lot of risks right now, which we saw earlier in the year. So I'm monitoring all of them. So you have to know what you own and what risks you have. Valuation does not bother me right now. I don't, as I said, I was hoping, please stay away from questions on gold prices or currencies or oil prices. I know none of this stuff. So I follow earnings. And you can buy, I am paying 2.6 PE points. All right. So you take the PE of the S&P 500. My fund is 2.6 points higher than the S&P 500. The S&P 500 earnings, looking out by the estimates, is I believe, 14.7. But the estimates for my stocks are over 30. So I'm paying 2 points for twice the earnings growth of the market. That's nirvana. So if people can go, well, the forward PE or the history PE, I'm like, really interesting to me, but I don't spend any time on that. I just need one new name. So I get up, I write on my paper thing, focus fund, one new name. And it's on top of my yellow page. And if I get up, I am a shopper. Who's ever shopped at TJ Maxx or Marshall's? I am a TJ Maxx shopper. The store is filled with lots of stuff. I get up in the morning and what got delivered last night that is mispriced? And I'm going through there and trying to find something that is great, that is you can get that is what I do. So if I can find one new name, I've had a good day or a good week, good month.
Interesting. Speaking of new names, there's a question about turnover. Are you happy if you go through a year, you don't find anything that needs to be replaced, that the portfolio is consistent a year later? Or is there a frequency that you look for?
I don't solve for turnover. There's great turnover, which is I bought the stock at 30. It's now at 92. And it's now reached where we've price point. And I don't stay too late at the party because rule number 2, which is don't get fired. And so as things get expensive, you can't keep, I try and keep my ratio of PE to the market in a band. And as things do appreciate, I recycle that money and put it down and put a new name in. And basically, as you talk about the Toronto Blue Jays, I basically am owning these stocks from inning 3 or 4 to inning 6 or 7. I don't buy them in inning 1, 2, or 3, and I don't own them in inning 8 and 9. I am right here. Your business is getting better. I think it can last longer or be higher magnitude. As people start writing reports about how that's going to happen, I'm saying, all right, people know it, and then I take the money and I recycle it in the next name. And so that's good. The bad turnover, which we had some earlier this year, was bad, would be you have a story. We had one company that it was an incredible company, but they did a lot of government contracting. And when you have Elon Musk on stage with a chainsaw saying he's going to rip up all government contracts, that usually is not good for a government contracting company. That one could not foresee, and that one irks me, still irks me.
Sorry about that. Sorry for that question. Let's move along. If you look at the top 10, one of the companies is DraftKings. There must be a story behind that.
Yeah, so you couldn't do online gambling in the United States until the Supreme Court changed the rules, 2018. Took people a little while to get from getting approval to get going. And then basically what they decided, each state kind of came up with their rules, but one of the main rules was if you have an existing casino, you get an online license with it. And so everyone you all probably didn't get bombarded with we spent the next 2 years with just all the advertising on TV.
Yeah,
now it's all drugs and it's all drug stocks. But back then it was basically, and they all fought it out. And so what happened is we went from MGM, Caesars, Penn Gaming, blah, 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 down to 2 players, FanDuel and DraftKings. And I owned a few of the casinos as I was learning this area because they made money. But the 2, DraftKings did not make money, but I started getting interested when they turned profitable. And so what's happening is when you do a single bet for gambling, they earn a 4% hold. And that is pretty good. But right now the growth is in parlays where you put 3 things together and the hold is 14%. So as their business mix changes, they have less competition. The promotion cost is going down. They're earning money, buying back stock. It's good, but everything has I'll go along, but now I have to worry about prediction markets, but that's tomorrow's problem.
Which market?
Prediction.
Okay.
So as I tell people, there is no perfect stock. So you're giving up something. You have to compromise on something. So I love listening to people and they say, I only buy stocks with great management, good blah, 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 blah. And I'm going, that's great. What stock is that? Because if you have all that, then the valuation's too high.
We're going to wrap up soon, but I wanted to go back to AI for a second because I saw today that also Apple lost a senior exec to Meta, and that's probably something that's going on a lot from an AI standpoint. Is that something that you see, a lot of poaching, if you will, from firm to firm?
Correct.
Is that a concern?
It all depends. So if you're losing people, it's a little concern, but it's kind of like the PGA Golf Tour. So some of these players went to live, and you sit there going, does that mean PGA's over? You can't look at that. So some of the contracts that Meta is giving these people, you're like, but if you are losing people, you need to watch it because a number of these people say there's basically 135 like AI gurus, and they're all fighting for these 135 people. And so as they're all changing seats, the money they're getting is astronomical. But I don't know, some of these football teams, if you look at them, they have a great quarterback, great running back like this, but they lose. So just because you go and get these people doesn't mean you're going to win. I mean, Notre Dame is playing USC this weekend. Not that I care. Love Notre Dame. But USC every year has like 3 times as many people go to the NFL as Notre Dame. I mean, you sit there and like, their quarterback looks good. He's going to go play. They're running back like this. But they lose because they're not a team. They're individuals. So just because you're going out and paying all these people money and they all have egos, kind of like portfolio managers, and you put them all in the thing like this, doesn't mean you're going to have a great stew. So I don't say, just because you got somebody doesn't mean, wow, you're going to be a winner. Because I've seen a lot of teams with great players that just don't, it's not a team. It's kind of like, it's like the NBA playing in the Olympics and stuff like that. Our team is 100% better, but some of these teams that have been playing together actually are a lot better than the prima donna NBA players.
You have a lot of great analogies. You also have a lot on your plate, but you seem to be processing it all very, very well, which is why there's been such great success. Congratulations on that. We have to go to, before we shut down,
Okay.
5 fun questions about you. This is something new, and this is something that's going to be unrelated to what's in the portfolio. First question, hidden talent.
Gardening.
I'd love to explore that, but we don't have time. Underrated vacation spot.
Ooh, underrated vacation spot.
Well, you're not allowed to read the question.
Oh, okay.
Yeah.
Underrated vacation spot. How long do I have to think about this?
3 minutes.
Okay, wow.
So,
Cape Cod.
Okay. Zoom calls or in person?
Oh, in person.
I like that. What's a movie or show you can watch endlessly?
Ooh. What is Wick, with John Wick?
How many times have you seen it?
Particularly during COVID, I got to the point where my wife told me I had to stop watching it because it was on either Wick 1, Wick 2, Wick 3. And so it would be on. I never watched the whole thing, but I always would watch like 20 or 30 minutes right in the middle. And then she would come down and I'd see her and I'd like, turn it off. But I could watch that. I could watch John Wick all the time.
Should Star Wars or Star Trek?
Ooh, Star Trek.
I'm not going to explore any more of those. We have 2 minutes left, so I do want to ask, what should we be thinking of as we approach 2026 market-wise? Just going back to that.
You're going to continue. We have green days, red days, green days, red days based on government closed, government open. We hate China. We love China. Rare earths, no rare earths, blah, 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 this, blah, blah, blah. But underneath all that stuff, there is a trend of a new technology. And if you turn on the TV, is it an AI bubble and blah, 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 and stuff like this? No. It hasn't even gotten to the companies using it. Okay, so we still have a long way to go, and there's going to be some great winners, and there's going to be some really bad losers. And so that's what I got to turn the card over and say, keep, don't keep, keep, don't keep. And so as that happens, it's a fascinating time because it's going to change a lot of things we do, how we process information and do stuff. And so it's an exciting time. This is an exciting time to be in the stock market because you're not asking, you say, what questions are you asking? I've been doing this a long time. And so you go into the company with no changes going like this. So how are sales? It's like now there's just new stuff and you can see some excitement and stuff. So this is a great time to be picking winners and losers.
It was fascinating to talk to you. Steve DuFour, thanks very much.
All right.
Let's move on.
All right.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.